Hello and welcome everyone. Thanks so much for joining us today for this presentation titled Rules of the Road, Purchasing an Investment Property. This is an American IRA presentation today on self-directed IRAs and 401ks. My name is Sean McKay, and today we're going to cover some of the basic components of what to look for and what to be cognizant of when you're purchasing an investment property, and certainly inside of a retirement account, but really these concepts are universal to whether you're personally purchasing these through an LLC or inside of your retirement account. You want to be cognizant of what seasoned investors are doing when they're purchasing investment properties. So before we get into that concept, we'll just kind of do a quick review of what a self-directed account is, and American IRA in particular. And so at American IRA, we are the third-party administrator for self-directed retirement accounts. And really what that means is that we do the record keeping and the administration for the assets held inside of your self-directed retirement account. So we're a small boutique firm. Our headquarters is in Asheville, North Carolina, and most days I'm in our sales office in Charlotte, North Carolina. And so effectively the rules of a retirement account are that regardless of whether it's a quote-unquote self-directed account or a brokerage retirement account, the retirement account is the same regardless of who is administering that retirement account. So even though it says self-directed, you will have still either a Roth, a traditional, a SEP, simple, solo 401k, whatever it might be. The retirement account itself will not be changing forms. The one exception to that is if you have an employer-sponsored plan. Most of the time those are pre-taxed accounts, and so that will typically roll over into a traditional IRA with us or with any other financial services firm that you're interested in working with. And also keep in mind this is not an all or nothing proposition. You can just simply move a portion of your IRA or 401k over to a self-directed firm such as American IRA. Now certainly today we're going to focus on the ability for the retirement account to purchase a property for either rental purposes or to fix it and flip it to make a profit in hopefully a short period of time. But keeping in mind that a retirement account can purchase raw land, condos, townhouses, all the way up to single-family houses and commercial buildings or apartment buildings as well. The IRA can also be a lender for other investors, typically in the form of a deed of trust or a mortgage, depending upon the state that you live in. Or technically they can lend money that is not secured by specific collateral. Certainly in doing so, you'd want to have a conversation with an attorney to understand the possible outcomes of what that investment would look like for you. And then there's also the ability to acquire precious metals, so gold and silver inside of your retirement account, the physical gold and silver. And also we're seeing an influx of clients that are investing in privately held companies. So this is a bit of a departure from publicly traded companies like the Apples, the Exxons of the world, and investing in companies actually in your community. And perhaps you might even know the principals of that firm. So it's a little bit more straightforward of a due diligence process, if you will. Now, especially when we speak about real estate, we want to be very clear on the concept of disqualified people. These are individuals that cannot get any benefit owned by an asset in your retirement account, nor can they provide any services to an asset owned by your retirement account. So we start with you as the account holder, your spouse, and your direct lineal family members are considered disqualified people. So they cannot, in the case of real estate, put a new roof on the property, install an HVAC system. You need to hire out third parties to actually provide those services. Also, entities that this group of people owns or controls, such as LLCs, companies, they're also in that disqualified group of people, if you will. So it's very important to note that your retirement account needs to always be hiring out vendors to provide services to assets owned inside of your retirement account. So the first concept we're going to get into is the rules of the road with rental properties. And rental properties in particular outside of retirement accounts actually are a personal favorite of mine. My wife and I have built a rental portfolio, and so certainly some of this is going to be speaking to the things we have done, and most importantly, some of the things that we weren't always so cognizant of being aware of when purchasing rental properties. And so when we look at rental properties, there's a few things that I highlighted that we want to be very aware of. And first is the idea of where you're actually going to invest. For some of us, we're going to want to invest in our own backyard, our hometown, or where we're currently living, or invest out of town. And so certainly there's some pros and cons that we'll delve into with that. And understanding the idea of cash flow. If it's going to be a rental property, it is absolutely mandatory that we understand the amount of money that we're making by owning this property inside of our retirement account, and also understanding the equity, essentially the discount that we're getting for purchasing this property, the difference between what we purchased it for and what we believe it to actually be worth. So when we look at hometown investing, to me there's many benefits of investing in either where you're currently living now or where you're originally from. And so that starts with the idea of just understanding the community, understanding the city that you're going to be investing in. I think certainly it goes without saying it's a huge, huge benefit to understand the good parts of the town, the bad parts of the town. So certainly you understand that a general part of town. So as we look at South Charlotte, there's certainly many beautiful areas and many quality areas for people to live, but there's some general areas such as South Charlotte that really you're going to be hard-pressed to find difficult areas or rough areas, if you will. And so every community is different, but just understanding that basic concept is a great way to start farming your area. And also, it's easier to keep an eye on the investment. So certainly we mentioned that we want to be passive with these investments. Ideally, you do want to have a third party, a property manager, if you will, overlooking this property and dealing with the tenants and what have you. But it's much easier to tell if a property manager says, hey, boy, we're having a lot of roof problems at this rental property. We need to put a new roof on. Well, if you drive by and you see, oh yeah, boy, this roof is starting to get quite weathered, and come to think of it, it hasn't had a new roof in 15, 20 years, then certainly it's very logical to come to an agreement with that property manager. And conversely, if you're driving by and you see, boy, the roof doesn't look rough at all and it's only been on there for 3 or 4 years, then you're able to discuss with the property manager and see what the real issues might be. But it's just much easier to understand the area and to keep your eye on that investment. Now, certainly for many of our clients, we have clients all over the nation. A typical story might be for someone that does not want to invest in their own backyard is that they live in a really challenging market to buy a rental property, areas where the price points are very, very high, and even though the rental income is high, it still doesn't make sense from an investment perspective. So we have clients that are in Los Angeles or Seattle, New York City, where the starting price points, quite frankly, might be $500,000, $700,000, $800,000, up to $1 million in some of the more expensive zip codes. And so certainly buying a rental property in those neighborhoods may not make sense. So they might be looking for other areas in their state or outside of their state to make an investment. So certainly that's something to be cognizant of. The other downside, which I think is kind of a secondary concern, but something to still articulate, is the idea of purchasing trophy properties. Sometimes I see investors that will invest in their own backyard and they love the idea of being able to tell friends or family that they own a certain house in a certain area that's really considered a high-end area. And so they like the idea of saying that in Charlotte, for example, they might say, I own a house in Eastover or in Myers Park, which is a very, very high-end area, and that's certainly a sense of pride. And that's terrific. We certainly want to be optimistic and proud of what we're doing with our investments, but from a rate of return standpoint, frankly, I think almost anywhere else in Charlotte makes more sense because the purchase price to the rent associated with other parts of town will be much more beneficial from an investment standpoint. Now, certainly if you're buying a trophy property at an enormous discount, if you're buying something at 50 cents on the dollar, yeah, sure. In the meantime of renting it, it may not make a lot of sense cash flow wise, but if you're going to sell it in at least the semi-near future, that might work out incredibly well for you. But just keeping an eye on the concept of this is for investment purposes. This isn't so we can drive our friends by on a weekend and say, boy, look at this $600,000 single family house that I purchased. We're trying to make the best rate of return that we can. And certainly in my humble opinion, if we're looking at rental properties, the most important concept is the idea of purchasing properties that have quality cash flow. And quality to me means a few things. Certainly the cash flow itself is pretty significant between what your expenses are and what your income is, but also the idea of consistency in cash flow. Everyone has a different perspective. Some people really like the idea of the rougher areas where they can buy a house for very, very, very little money and still get a solid rent rate for it. But sometimes you find in those neighborhoods that the rate of return doesn't always end up being what you think the numbers will be on the front end when it's kind of theoretical. So for example, if you're purchasing rental properties in an area where you can buy the rental for $30,000 and you can rent it for $800, yeah, those numbers sound fantastic. However, if there's a lot of break-ins and there's significant tenant turnover and the tenants are tearing up the property, what you'll find is that $800 is not consistent and you get to keep very little of that $800. So I think certainly for all of us, we're trying to find that balance between the best theoretical cash flow and the best property that can perform consistently for our rental portfolio. And so certainly when we're looking at rental values, we need to understand the return on investment, understand kind of the mechanics of the numbers and how we can actually analyze that. And so this is an example that I've used, frankly, just off of a rental property my wife and I own, and it's really just for illustrative purposes, just to kind of understand the analysis of the numbers for a property. And certainly everyone is going to have a different perspective on some of these components in terms of how much to put aside for maintenance reserves or CapEx, if you will. This was an analysis, frankly, that we did years ago, and I think that, frankly, my wife and I have become even more conservative and would put an even higher number for that field of maintenance reserve or capital expenditures, maybe as a separate line item for some people. But the basic premise is that the gross rent, what you're charging the tenant, what the property manager would be collecting would be $900, and you're factoring out some figure for vacancy. Now, certainly the rental market in most cities and states is pretty terrific right now, so a 10% vacancy is very, very conservative. But as I said, we've gotten more conservative over the years, so we'll just plug that in as kind of a worst-case scenario, and it's always great if your real numbers end up being better than the assumptions that you're making anyways, right? So 900 collected, 10% for vacancy, so adjusted gross income of $810. Now, certainly a lot of these bills will not be paid on a monthly basis, but you can kind of break them down from their annual number to a monthly number to understand your monthly cash flows. So a tax number, your insurance number, those are going to typically be paid once a year. Those are $85 and $40 a month, respectively. And then a 10% management fee. Certainly on the surface, a 10% management fee is a bit high. Some people will say, well, boy, I can get property management for 6 or 8%, and certainly that's very doable. And as we've started to transition with our non-qualified portfolio, we are using property management that is lower than 10%. However, keeping in mind that with property management, many times they have a lease-up fee. And at least in Charlotte, what seems to be fairly common is the idea of the property manager getting 0.5% of the first month's rent. So on this $900 rental, they're going to get $450. And sometimes there's even a minimum. It might be half the first month's rent, but a minimum of $400 or $500. So really understand that 6% can balloon up to 10%, especially if there's a little bit of turnover with that property. And keep in mind the 10% is of the adjusted gross income. The property manager is not going to get paid on months where it is vacant. You need to make sure that it is just off of the collected rent. So if it's vacant for a month, even if the rent's $900, your property manager is not getting the 6 or 8 or 10% of zero, quite frankly. Maintenance reserves, as I said, we're plugging in $100. We're kind of counting CapEx, capital expenditures, things like roof, HVAC units, things like that, in that number. I think that in today's numbers, when we're running those numbers between the maintenance reserves and the CapEx, it's for us usually going to be $150, if not $200, depending upon the type of property it is, whether it's single family versus multifamily, et cetera, et cetera. But in this example, those expenses come to just over $300 a month. And so the net operating income is $500. So you're bringing in all the income, you're taking out the expenses, and you're left with essentially $500. And so if you take that over a 12-month period, you're looking at just over $6,000 in net income to you as the investor. Now, keeping in mind, in this example, we purchased the property for a little over $60,000, so that's roughly about a 9 or a 10% return on investment that you're getting for that purchase of the property. So keep in mind, in this example, there is no debt on this property. If you had a mortgage that was $400, you would be subtracting that from the net operating income. So your net operating income is $500, your mortgage is $400 for principal and interest, so you're really only cash flowing $100 a month. Now, if you had to put very little into the deal, that still might make a whole heck of a lot of sense, but this is just a very, very straightforward cash deal for us to look at. Now, as we look at cash flow, a lot of us like to just do some very rough numbers when we're looking at a volume of potential deals. And one of those concepts is the idea of the 50% rule. And really what the 50% rule is that it says you take the gross income, what you think the property rents for, so in the previous example, $900, and you say that somewhere around half that money, assuming not counting the mortgage, but just the general operating expenses, taxes, insurance, management, maintenance, capital expenditures, is going to be about half of the gross rent. So $900 rental, about $450 is a very conservative number for how much of that cash flow goes towards the operating expenses. And then certainly if you're going to have a mortgage, you're going to run that off of the remaining $450 to be able to pay that mortgage. So that's the 50% rule. So anytime you're looking in a neighborhood and you're talking to property managers or other investors and they say, yeah, in this neighborhood for a 3-bedroom, 2-bath, 1,500 square feet, you're going to be looking at $1,200 in rent. You say, okay, of that $1,200, $600 goes to expenses. If my mortgage is going to be $450, I'm going to get about $150 a month in true spendable cash flow. The other concept is the idea of a 1% rule, where essentially if you are purchasing a property for $100,000, you want to get at least $1,000 in rent. And so with that, that's kind of a general rule of thumb to get some general cash flow return on investment. Now, depending upon how you run your numbers, for you that might be a 7% rate of return, 8% rate of return. I've even heard people say that 1% rule yields them about a 10% rate of return. So that's kind of a more advanced concept, but the idea of just being able to look at a neighborhood and say, between purchase and rehab, I'm going to be into a property for $150,000, and it's going to be about a $1,500 rental. That makes it what we call a 1% deal. Now, certainly with those numbers, if we were buying the property for $100,000 and we're able to rent it for $2,000, that would be a 2% deal. More commonly, you might buy something for about $60,000 that is going to rent for about $1,200 a month to make it a 2% deal. Obviously, I'm talking in the North Carolina market and the greater Mecklenburg County or Charlotte market. As of 2016, you're going to have to work a little bit for those deals. They're not on the MLS as they were a few years ago, but 1%, 2% deal, and then the 50% rule. The other concept is the idea of equity. So we spoke about cash flow and understanding what portion of that gross cash flow actually gets put into our pocket personally, or if it's inside the retirement account, goes back into that retirement account. But then there's also the idea of how much of a discount we're purchasing the property at, how much equity there is. So if the property is worth $100,000 and we're paying $75,000 for that house, we're buying it with 25% equity or $25,000 in equity. Now, equity for rental purposes, as I mentioned, is kind of a secondary concern to making sure it actually cash flows, but equity can be very useful for us because it shows us that we have a margin of safety in the investment. And margin of safety inside of our retirement account could mean a few things to us. If we're buying it, especially at the top of the market, and certainly we typically only know the very, very top of the market looking back in retrospect when we have all the statistics to really understand what that market cycle looked like for us. But in buying at the top of the market, if the price is $100,000 and we're buying it for $75,000, we know that at least even if the market comes back a little bit, we owe or we paid a little bit less than what it's still currently worth. If the $100,000 house becomes a $85,000 house, if we purchased it at $75,000, we, at least on paper, have a little bit of equity in there. Now, as it pertains to our clients, one of the questions that I get asked very frequently is what happens in my retirement years when I want to start pulling money out to live off of or to, spend vacations, whatever I deem appropriate. And so certainly the initial concept will be for individuals to draw from their liquidity, whether that's cash in the account, whether that's from securities like stocks and mutual funds that they own. But if that's not enough to cover whatever their specific need is, then there might be a need for the client to actually sell assets such as real estate so that they can get in a cash position and draw from that cash. So certainly the more equity we purchase that property with, the more equity we'll have, once again, if the market's not exactly where we'd like it to be when we have to sell, and be able to get as much cash as we can out of that deal. So the next concept is fix and flip properties and how we need to understand the numbers and the basic components. And so certainly if you're going to be buying a property and rehabbing that property, putting money into making it a much nicer property, to me the idea of understanding market cycles, at least from a very basic standpoint, is very prudent. Understanding if prices are going up, down, etc. The next concept is understanding the subject neighborhood. So certainly in my mind, especially in the beginning of our career of doing fix and flips, we want to be investing in our own backyard in an area where we really truly understand the specific neighborhood, not just the city, but the actual neighborhood that we're buying the investment property. And understanding the sweet spot to sell quickly. Certainly when we're doing a fix and flip, the longer we're holding that property, the more risk is associated with that investment. And so getting in and out of those deals is prudent and certainly necessary to making as much money as we can. The longer we have that property, the more there's holding costs, etc. And then the concept of financing that property versus simply paying cash, and especially how that affects us when we own that asset inside of our IRA or 401k. So understanding the market cycle, so certainly inherently a lot of this stuff we understand, but it is important to kind of have a checklist and really be methodical when we're looking to purchase an investment. So many of us, and sometimes regardless of how long we've been buying investment properties, we get caught up in a particular deal, whether it's the neighborhood, whether it's the price point at which we can buy it, and we're very, very excited, and sometimes we throw caution to the wind and we're not methodically going through whether this makes sense for us to take on. And so we need to really understand what the prices are doing in our city, and is it smoking hot, is it just kind of leveling off, or are the prices actually starting to go down? And so certainly there's a lot of great resources we can use, but certainly one of those primary resources is realtors and understanding what's happening, especially in that neighborhood. To me, when you're speaking with a realtor, and I think also mortgage brokers as well are a great resource, it's really prudent to understand what's happening. Are houses staying on the market for longer and longer, meaning that certainly that's an indicator it's starting to soften in that neighborhood? Or are prices going on the market and then first day or two on the MLS, there's tons of offers and tons of interest and really strong buyers, cash buyers, etc. Certainly those are going to influence our confidence in our ability to sell this house quickly, because it's great to buy something, but in a fix and flip, we got to be able to sell it quickly. And so certainly when we're looking at that market cycle, we understand that prices go up and prices go down. And historically, it looks like waves coming towards the shore. There's the peaks, there's the troughs, and there's everything in between. We need to understand that if we're employing a strategy like fix and flip, we do not want to be doing this for a significant portion of our portfolio if we're in a severely declining market. I'm originally from Florida, and so certainly if you were flipping houses in 2008 and 2009 as things are crashing, that's tough. That's tough to find qualified buyers. It's tough to find someone who frankly even wants to buy a house at that point. It's tough to price it where it makes sense, because you might buy it at $100,000 and then 6 months later it's worth $85,000, or God forbid even worse than that. So it's really important to understand riding that wave up is really going to be the most prudent way to do the fix and flips. Now conversely, if we're playing market cycles, which we kind of have to do with fix and flip, we also need to be aware that in the world that we live in today, a specific unusual event, if you will, can dramatically affect not only the city that you live in, but the credit markets and the abilities for buyers to actually get financing to purchase the property. So once again, in my very humble opinion, I think that certainly doing fix and flips is a much more risky strategy than purchasing a nice steady Eddie rental property, but certainly it's a sexier concept, and it's one where you can make significant chunks of cash if done correctly by doing a fix and flip. Now when we are looking at the particular neighborhood, we need to understand that we can look at a general neighborhood, but understand there's going to be good and bad parts of the neighborhood. So just because somebody told us that if you buy a 1,000 square foot house in this particular neighborhood, we'll call it Windsor Park, for example, that every house in Windsor Park that's $100,000 is, or excuse me, a 1,000 square foot house sells for $100,000. On some streets it might sell for $130,000. In other streets it might sell for $80,000, and it's really based upon the nuance of the neighborhood and the ownership that you see amongst different streets. Some streets might be much more rental properties, and so the values are a bit more suppressed than other areas where there's huge pride of ownership, and there's not a lot of rentals and tons of curb appeal to those streets. Those are going to sell for significantly more. So there's kind of an art and a science to understanding the neighborhood. There's the visual component, but there's also the numbers component. So when we look at numbers, we really want to see sold comps and the most recent sold comps, the better. So ideally within the last 6 months, we are understanding what things are selling for price per square foot. And also bedrooms. You're buying a 3-bedroom, you want to understand the 3-bedroom sold comps, not the 4-bedroom or the 5-bedroom. Same thing with baths. If yours is a 1.5 and it's going to stay a 1.5, don't compare it to even the 2-bathroom properties. Those are going to sell for significantly more than your 1.5s. Garages. Some older neighborhoods, it's common to not have a garage, and that might be okay, and you're still going to find buyers. But understanding that you want to compare apples to apples. If one house sold for $180,000 in Windsor Park, but it had even a 1-car garage and yours does not, there's going to certainly be more value in that property with the garage, obviously all things being equal. And then the style. So certainly there's many different types of styles of houses, but you want everything to be as even as possible. So if you purchased a split level, you want to look at comps on the split levels that have sold, not necessarily the 1-story ranches or the 2-story. You want to look at the most similar properties that you can possibly find to your style of house. And that also goes with siding as well. Brick house to brick house, vinyl to vinyl, et cetera, et cetera. You want everything to be as even as possible. Now, one thing I think that is really overlooked when we're looking at the art component is, as I mentioned earlier, understanding the street by street, but actually driving it. So many of us now do probably too much of our work just sitting behind a computer and looking at different websites. They're a great starting point for us to look at a site like Zillow.com to understand the sold comps, not for sale, but the sold comps of what's happening in your neighborhood. But then I think it's really prudent to drive that neighborhood and to be involved and to see what's actually going on the ground level, because the comps might look great, but you might drive through the neighborhood and say, boy, this neighborhood looks like it's kind of a little bit beat up and it doesn't look as good as I remember from a few years ago. That really tells you something, and always go with your instincts. Every time I go against my instincts, not every time. Sometimes I'm flat out wrong, but sometimes my instincts are really right. And so it's a good idea certainly to get advice from other people. But if you're not comfortable in the neighborhood, you might not be able to sell that house to the type of buyer that you think you're going to sell to. And so in terms of the neighborhood, I like to drive it, but I also like to walk the neighborhood. My wife and I, we would go on a walk and we would talk to neighbors, see if they're friendly, just kind of get a feel for what's going on. If everyone looks really kind of nervous and concerned for just individuals to be walking down their street, then that's a situation where maybe there's concern. There's been some break-ins and negative stuff going on in the neighborhood, and so people are a little bit on edge. That certainly tells us something. And also, once we start a rehab project, we understand there's lots of materials in the house. There's a lot of ways we can lose money. And then also on the back end, selling to that retail buyer, we're going to want to sell to someone who feels comfortable living in that neighborhood. So as I mentioned, a lot of this certainly is common sense, but it's really just kind of prudent to thoroughly go through and do the analysis, not just of the house, but the overall neighborhood. And I've also become a big fan of going to homeowners meetings, certainly making them aware on the front end that you do not currently own a house in the community. They may or may not allow you to stay there, but if they are welcoming, it's a great way to find out what's happening and what's on the horizon for the neighborhood. Is it a situation where the HOA is discussing some great things that are happening close by? Maybe there's some new high-end community that's going on next door, and they feel like this is really going to help them to regentrify their area, and there's a lot of good things happening. Or is there kind of negative news and things that they're trying to rally as a community? So I think that can be very helpful for us as well. And sweet spots to sell, really, once again, it's very crucial for us to understand on the front end who our end user is going to be, who our end buyer is going to be for this property. And I see that a lot of times individuals, especially in the beginning, will want to sell retail properties on the lower end because they feel like they can buy a property cheap and the retail price won't be that high, so there's a lot of people that can theoretically afford it. And certainly that is true, and it's different in every market, but we find that, take Charlotte once again for example, at a certain price point, let's say certainly under about an $80,000 retail sale price point, it is challenging at the moment to get a buyer who's going to have the necessary credit and or down payment needed to actually be able to buy that property. So you might have 30 people that think that you created a beautiful property and really nice finishes, but if they can't get qualified to get a mortgage, then that does not do you a whole heck of a lot of good. So certainly on the front end, if you understand where the buyers are, where the lenders are in terms of lending to those potential buyers, that really gives you a lot of working knowledge. And certainly once again talking to realtors, there was a realtor who was speaking about in Charlotte, houses over $600,000. That market is starting to soften a little bit. So that tells us if you're doing a really high-end spec house or fix and flip, that you're going to be in a situation where the buyer pool, for whatever reason, is shrinking. And certainly I don't deal in that market, so I didn't really have the need to follow up with the specifics of why that was the case, but that's really important. Certainly friends of mine in town that are doing those high-end spec, they like to have that information so that they can plan their business accordingly. Really important, once again, to understand with the realtors, with the investors working in your neighborhood, what are the finishes needed to sell to a retail buyer for the price you want and to sell it quickly. You don't want stuff sticking on the market for months and months. You want everybody to want your property. And so understanding what are the finishes? Do we need the stainless steel appliances? Do we want granite countertops? Even down to what are kind of the hot colors that people are using for the interior. What kind of, is it a grayscale? Is it, lively, bright colors? What seems to be selling very quickly these days? What kind of outdoor living space are they creating? Is it porches? Is, all sorts of things that we can go into. It's really, really important and useful information to understand what we need to do to this house to make it sell as quickly as possible. I would also note that this is the most important before you even purchase the property, because when you understand all of the money that's going to need to go into the finishes, you can then back out your numbers and understand what you actually need to buy the property for this to be a profitable business venture for you. So when we talk about the acquisition of the property, there's the concept of whether we're going to pay cash or finance the property. So with a cash purchase, certainly to me it is a less risky proposition if you're buying a fix and flip and the purchase is going to be 100 and the rehab's going to be 50 and you have well more than 150,000 in your retirement account. Many times clients will just simply do a cash purchase for that property. They won't have to make mortgage payments, and I guess psychologically they feel like they have a bit more time to do the property right. To me, the other benefit is it gives you more exit strategies. If you have the necessary capital to do this deal and you're into that house for $150,000, and let's say there's some world event, the credit markets collapse and nobody's able to get financing or the buyers are scared and you need to turn this into a rental property, well, if it rents for, say, $1,100, it might not be the return on investment that you were hoping for, but you're still going to be able to pay your bills and it's still going to cash flow for you because you don't have a mortgage on that property. So you have multiple exit strategies. Plan A is fixing and flipping, but Plan B can also be turning it into a rental. Now, with loans, the benefit of the loans versus buying a cash property is you can do a bigger deal than maybe you otherwise would be able to. So in that example where it is $100,000 for purchase and $50,000 to rehab the property, if you have $80,000 in your IRA or 401k, you wouldn't be able to do that deal. So that's a real downside of the cash purchases, is you're relegated to the amount of available capital versus with putting a loan on the property, you need to, or you have the capacity to do a deal that's bigger than your available cash. Now, one thing to be cognizant of is if you're doing financing inside of your retirement account, there is going to be a very particular type of loan you need to get called a non-recourse loan. It needs to be non-recourse debt, meaning you are not personally guaranteeing as the account holder. The lender understands in case of a foreclosure, they can just simply take the property back, foreclose and own that property. They cannot sue you as the account holder, and they cannot sue the retirement account that is actually the technical owner of the property and is actually getting the loan. So definitely feel free to speak with us if you have questions, but it needs to be a non-recourse loan. So that's kind of the gist of it, rental properties versus fix and flips. Hopefully there was at least a nugget or two in there, something to consider in your due diligence process as you're looking to get into either of those strategies. But certainly before you do anything, it's important to understand kind of the ABCs of self-direction. First, you need to create the self-directed account by filling out our application kit and establishing either a traditional, a Roth, a SEP, a simple, a solo 401k, whatever type of retirement account you're going to be opening. The second phase is to get that account funded, either with a transfer, a rollover, a contribution, whatever the case may be. And then the third component is to select the particular type of investment. So it might be a single family house, it might be raw land, but ultimately we are going to be involved in that entire process. So call or email us before you fill out any offer to purchase so that we can send you the instructions and verbally go through that process as much as you like so that you can ultimately have your retirement account acquire that property. So I certainly appreciate everyone's time today. My information is Sean@AmericanIRA.com. And that's SEAN@AmericanIRA.com. Our website is AmericanIRA.com. The headquarters in Asheville, the office number is 828-257-4949. And the Charlotte office number is 704-633-8155. Once again, I really appreciate everyone's time today. I hope to see you at a live event, and thanks so much for taking the time to listen. Have a great day.